Welcome to Breach TV and to another market overview, where we break down the biggest economic and financial stories shaping global markets. This week, US regional banks reignite fears of another credit crunch. Europe pushes for a bold new reform to unite its capital markets, and S&P Global makes a $1.8 billion move into private market intelligence. What does all of this mean for investors, businesses, and the global economy? Let's break it down. Once again, US regional banks are back in the headlines. Investors' confidence was rattled this week after Zions Bank Corporation and Western Alliance Bank Corporation revealed fresh credit-related issues. Zions reported loss tied to two commercial loans, while Western Alliance filed a lawsuit accusing Cantor Group v. LLC of fraud, a claim the firm has denied. Now on their own, these may sound like isolated cases, but they came just days after two auto sector bankruptcies, First Brands and Tricolor, raising red flags about the broader health of corporate credit. Analysts were quick to say that these incidents don't signal another 2023-style banking collapse. But sentiment doesn't always listen to the logic. As Timothy Coffey from Janney Montgomery Scott said, markets are gripped by a sense of fear and panic, and that fear quickly spreads across continents. The key BW Regional Banking Index plunged 6.3% on Thursday before rebounding slightly on Friday. The large cap bank index also dropped over 3%. In Europe, the sell-off extended to Deutsche Bank, Barclays, and other lenders, all losing around 6%. Asian markets felt it too, with Japanese banks and insurers seeing declines. This kind of synchronized sell-off tells us one thing: even small cracks in regional banking confidence can now ripple across the entire global system. So what's the big deal? Regional banks in the US might not be Wall Street giants, but they're the backbone of local economies. They finance construction, small businesses, auto dealerships, and commercial real estate projects. When these banks get nervous, they pull back on lending. And when lending dries up, economic activity slows. That's how a few isolated credit events can snowball into a broader slowdown. This cycle, often called a self-reinforcing feedback loop, looks like this. First, banks tighten lending, businesses borrow less, hiring slows, unemployment rises, consumers spend less, defaults increase, and as a result, banks tighten again. And before you know it, you have got a credit crunch turning into a mini recession. This week's events don't mean that we are there yet, but they do show how fragile the post-crisis banking landscape remains. Even after the 2023 collapses of Silicon Valley Bank and First Republic, trust in mid-sized lenders hasn't fully recovered. One bad headline can still shake the entire sector. Third quarter earning reports due in the next few weeks will be critical. Investors want to know, are these losses isolated, or are we looking at early signs of another credit deterioration? Until then, expect volatility and a cautious tone from both banks and the Federal Reserve. Across the Atlantic, Europe is preparing for what could be one of its most ambitious financial reforms in decades. European Investment Bank President Nadia Calviño urged the European Commission this week to pursue the proposed 28th regime, a framework designed to finally make it easier for startups to operate and raise money across all 27 European Union member states. Here is the problem. Right now, Europe's startup ecosystem is fragmented. Every country has different tax codes, securities laws, and reporting rules. So, a German startup expanding to France faces a mountain of red tape that slow growth, deters investors, and pushes innovation overseas. Meanwhile, in the United States, startups can raise funding across all 50 states under one legal system. That's why Silicon Valley and Wall Street can scale companies so quickly. If implemented, the 28th regime could change that. It would create a unified European Union framework for raising capital, IPOs, and cross-border M&A. For investors, that means fewer barriers, more liquidity, and better access to high-growth sectors like clean tech, AI, and fintech. It could also help Europe close the innovation gap with the US and Asia and reduce its reliance on American capital markets. But there's a catch: politics. Some European Union governments don't want to give up control over tax and regulatory policy. Negotiations will likely stretch well into 2026. Still, If Europe pulls it off, it will mark a genuine leap forward, not just for startups, but for European competitiveness as a whole. As Calviño put it, this isn't just about innovation, it's about economic sovereignty, ensuring Europe can fund its own future rather than rely on external capital. And finally, in corporate news, S&P Global is making a strategic $1.8 billion move that could reshape how investors access data. The company announced it will acquire With Intelligence, a UK-based analytics provider for private markets. Why is this a big deal? Because private markets, think private equity, infrastructure, and private credit, are now one of the fastest growing areas in global finance. But they are also notoriously opaque. Investors often struggle to access reliable data on performance, valuation, or risk. With Intelligence fills that gap, and S&P wants to own that space. The firm serves about 3,000 clients worldwide, generates around $130 million in annual revenue, and its contracts are growing in the high teens per year. For S&P Global, this acquisition does two things. First, it expands its data coverage beyond public markets and credit ratings. Second, positions it to compete directly with BlackRock, Bloomberg, and Morningstar, all of whom are moving aggressively into private market analytics. This is part of a much bigger shift in modern finance, where the real power lies not just in managing assets, but in controlling information. In a world awash with data, whoever owns the best analytics wins. And for investors, this consolidation means better transparency, also more dependence on a few massive data providers. By 2027, the deal is expected to start adding to S&P's earnings, but the real impact will be strategic, giving S&P a seat at the table in the $13 trillion global private assets market. So, what's the big picture this week? US regional banks reminded us how fragile credit confidence still is. Europe is preparing to rethink how it funds innovation. And S&P Global is betting big on data as the next frontier of finance. Each story connects to one theme: trust and transparency. Whether in banking, regulation, or data, the health of the global economy depends on both. As always, the coming weeks will bring more clarity, especially as earnings season ramps up and markets react to new inflation and employment data. We will be watching it all here on Bridge TV. I am Rasul, and this was your market overview for October 13th to 17th. Don't forget to like, subscribe, and share it if you found this useful. Until next time, stay informed, stay sharp, and stay ahead.